and welcome back to the Tech Talks Daily podcast, the show where we delve into the world of technology, examining its impact on our lives and how it's shaping our future every single day of the week. And today we're going to be joined by a visionary in the tech investment landscape. Her name is Raphaëlle D'Ornano, and she is the founder and managing partner at the D'Ornano+Co company, which is a renowned global advisory firm that dissects the intricacies of tech and tech-enabled companies, ultimately helping them evaluate their long-term resilience and investment potential. And I've invited her on the podcast to join me today to discuss the transformative technologies that she's seeing impacting investment strategies. And we'll also talk about the need for businesses to think counterintuitively about emerging technology, and also the driving forces behind the next wave of business innovation in sectors like ClimateTech, AgTech and HealthTech and so many more. Hopefully we can also find out more about why she believes that the current due diligence methods often fail to account for growth. And this is something that is so important, in fact probably more important than ever before. But enough from me. Buckle up and hold on tight as I beam your ears all the way to New York, where today's guest is waiting to join us. So a massive warm welcome to the show. Can you tell everyone listening a little about who you are and what you do?
Well, thanks, Neil, for having me on this show. So I'm Raphaëlle D'Ornano. I am the founder and managing partner of D'Ornano+Co, a management consulting firm that sits at the intersection between financial and legal due diligence and strategic consulting. We advise global investors in assessing the intrinsic value and resilience of what we call high growth and disruptive companies. So companies growing double-digit growth that present a characteristic of disruption. We do that across all asset classes, from venture capital to very large buyouts and going through M&A. And we have had the opportunity to complete over 500 assignments since I started the firm in 2015. So that gives us pretty good lens on the whole investment landscape and on what has happened to these companies. So that's what I do from a professional standpoint. Otherwise, I am the happy mother of two young sons, Arthur and Stanislas, and I run marathons in my free time.
Wow. How do you have the spare time to run marathons? I know the training that goes into that. That's phenomenal. And something I always try and do on this podcast is take the guest back in time. So I'd love to learn more about your origin story, the journey that ultimately would lead to you founding this company, and also the mission of reshaping the due diligence process for tech investments, because I've got a feeling there's got to be a story there, right?
I started my career at Deloitte, where I rapidly had the opportunity to conduct due diligence assignments on mid-cap companies. So I was very rapidly exposed. And at that time, I had just completed my MBA in finance in Paris, and I chose to go to law school at night and on weekends, because I was working at Deloitte, of course, in parallel, to develop a more holistic approach to my work as a consultant. And I was convinced that having a business law perspective added in my finance job would give me much broader lenses. So when I had my law degree in hand in 2015, I decided to jumpstart the company in a very entrepreneurial way, because I had basically no clients, no credential, no money, and no tea. But I was convinced that a new approach to diligence was needed, one that could bring more business perspectives by mixing these financial and legal aspects together. And at that time, tech was just starting in France. Like in 2000, a couple of years later, in 2017, when we had our first major assignment on a chatbot company, which is quite basic in tech right now, but which was quite revolutionary at that time. Well, we found through that assignment, the perfect spot for application of this new methodology to approach diligence in a different way. So we started with this first assignment in class, and dozens of assignments followed very quickly in 2017, 2018, at the time where French tech was developing massively. And very quickly, we came at the top of the league tables in financial and legal due diligence, auditing on these high growth and disruptive businesses that we didn't call like that back then, just called them SaaS businesses mostly, but we turned that later. And I got convinced that looking at a business that is rapidly growing and disruptive needs a different way to be looked at to be relevant. And so rather than looking at the past, because the past is not going to tell you much about these companies, you need to get a conviction on the future. And more precisely, you need to get a conviction on 3 points. Where and to what extent is the company going to grow and for how long? So what I call the duration and the magnitude of growth. Then what will the steady state operating margin look like when the company has reached that maturity and stopped high growth? And last but not least, how much cash is needed to get there, both CapEx and capitalized R&D. So when assessing a high growth and disruptive company, you need to take an approach that is not backward looking, but that is based on gaining a conviction on these 3 points to be able to create the pathway in some sort and to be able to follow if the company is on track or not. And that's how you're able to fundamentally assess the intrinsic value of the company and to assess its resilience. So fast forward hundreds of assignments later and a leading position as a financial and legal DD provider in European tech, we created our own due diligence category, which we call hybrid growth diligence. And hybrid growth diligence is a new form of due diligence that layers a very highly analytical approach to diligence on top of a strategic understanding of business models. And this allows to uncover what is needed to look at the right KPIs and to benchmark what you're seeing against a given development stage at a comparable company. So that's what we did. We created this category that we call hybrid growth diligence. Hope that answers part of your question.
Yeah, it's been a great ride for you. I love everything that you've achieved here and what shaped your journey. And I'm curious, fast forward to 2023. From your perspective as a global tech advisor, what transformative technologies are currently having the greatest impact on investment patterns and why? Is there anything that you're seeing around this at the moment?
Sure. So sorry if I'm going to disappoint you, but I'm not going to start with talking about generative AI. I'm going to come to that just after. First, I like to talk about something that is really interesting, which is what is happening in deep tech. Now, if you look a couple of months back and you go back to the New York Deal Book Summit last fall, Larry Fink said, well, the approach to tech investing is going to change and people are going to look at more scientific projects. And I think he was right. And that's what we're seeing at the firm. So we've had the opportunity to look at great companies in space, companies that are fundamentally shaping our economies of 2030, but which have very different characteristics from your traditional SaaS company that we started with, because deep tech business models require a whole different approach to analyzing them. You have very CapEx intensive models because you're building manufacturing plants, you're building like supply chain. So this is not an asset-light model at all. You have a lot of cash to be spent to hit like the right level when you're actually producing the goods, rendering the services. So it's a much more long-term approach than classic business because time to revenue and time to EBITDA is much longer with a lot of CapEx intensity. And so, for example, we've had the opportunity to work on 2 great assignments at the firm. The first one is the exploration company, a Berlin and France and Paris-based company that is democratizing access to space exploration. So this is an amazing company and has global ambitions, and that is really operating in the field of space tech. So again, something where revenue will be hit in the later stage, but like a whole plan that is developed right now, of course, and lots of contracts that are being signed. And the second one is Insect, which was a massive round, 175 million euro round that we just completed. And Insect is revolutionizing the whole food value chain, and through allowing like alternative proteins to have like a more sustainable ecosystem and more sustainable food chain. So those 2 companies are really exciting, and I have many other examples. So that's what's happening in deep tech. I think deep tech is going to be big, again, with different lenses to be correctly assessed. Of course, generative AI is full of excitement also. and generative AI, not just as a vertical in itself, but as something that is spreading to all those SaaS business models and that is having great impact in transforming your traditional software business model with much newer capabilities. And what's happening in generative AI is exciting at the model level, of course, with many questions on what are the right revenue models, how are you actually getting, how are you receiving money for your service as a provider of the model. So there's many things that need to be figured out right there. Of course, there's a lot of companies as vertical SaaS applications in AI. I'm thinking of Jasper, which is an Insight portfolio, which is an amazing company, and the whole stack in between the models and the vertical applications around ML ops, which is full of opportunities with one question, which is the ability for those companies to not just be individual tools, but actually reach platform status. So generative AI is something that there's many questions that go much beyond tech investing and that reach ethics, philosophy, regulation. And I think everyone is doing a great job in figuring that out. And many things are going to be seen in the coming weeks, in the coming months from Europe and from the US. But from an investor perspective, even though the situation is difficult, and we'll go back to that perhaps, we're in a transformative period where foundational businesses are being built in tech, both in deep tech and through Gen AI. And I think this is full of excitement and full of opportunities if you're able to assess these companies in the right way.
100% with you. I've just returned from a trip in Estonia, which has built a digital society now. Everything's online. I think 99% of their government services are online. And the big focus that I was hearing there from just about everyone that I spoke with at an event and around about the town there is deep tech. There's a huge focus on deep tech there. So I think you're bang on the money when you were talking about the return of deep tech there. And I'm curious, are there any other counterintuitive ways that businesses should be thinking about when exploring emerging technology? And how might this kind of thinking enhance their long-term resiliency? Because again, it's a big topic right now, isn't it?
So I think that what we're seeing now is that generative AI has reached a point where emerging technologies are having such a big impact that they cannot be limited to venture capital anymore. I think we reached a point, COVID was the first trigger, and for me, this is perhaps the second trigger, where emerging technologies do not belong only to venture capital, but have reached a much broader sense. That's, I think, first point I want to. For me, and this is a fundamental conviction that I've been having for many years is that every investor must become a tech investor. Every company that will have a sustainable future and that will show resilience is a company that is at one point able to transform itself into a tech company. Now, what do I mean by this? Of course, you have internal digital transformation. You have integration of generative AI, for example, in some fundamental processes of enterprises. So not transforming the whole company into a Gen AI company. That makes no sense. It's basically integrating in those processes that are requiring a lot of labor, a lot of time, and that are fundamental to the company's value creation, AI solutions that will make things better. Second, it's incorporating software and AI through external acquisitions, so through M&A, to be able to act as a software company, and not only as a company producing goods, delivering care, etc., but having software as a core value proposition. And that brings two things. First, it brings market leadership. I am convinced that to be a market leader, you need to master the data that is in much larger amounts and that allows to get products out there quicker, better, to know better your customers, to target their needs. So having AI as a company for sure allows you to have market leadership. That's fundamental. Second, it allows you to build recurring revenue. And recurring revenue in models that are not software-based allows to build a resilience that is much higher, and companies that will be able to commit to have recurring revenue will for sure command higher valuations. So this is something that is very important and that companies must master today. And I'd like to take a concrete example, which is a company called EDEX on the NASDAQ, so listed on the NASDAQ. For nearly 4 years, EDEX has been expanding what's possible to enhance the lives of pets. So it's changing the way pet care is done. It's bringing through data, software, the right solution to profoundly transform the veterinary care value chain. This is a great company. They're having a fabulous momentum, and they've been able to pivot a company that was producing pet care into the software, data, and pet care company with a very high value. So that's an example, and there's many others, but this one came to mind.
And given your insight into other key areas at the moment, such as ClimateTech, AgTech, and HealthTech, are there any other key trends in these sectors that you're seeing, and especially how they're driving business innovation right now too?
Sure. So these sectors are very different, and this calls for multiple answers. So let's start with ClimateTech. So ClimateTech is with Gen AI, one of the most exciting verticals right now, sure, because of the imperative of net zero, an imperative for everyone and not just for investors, by the way. And ClimateTech is producing those technologies that will be necessary to reach net zero by 2050. So what we're seeing in ClimateTech is we have a lot of companies offering decarbonization solutions that are measuring in a much more precise way GHG emissions, which is fundamental to even start the net zero roadmap. So there's a lot of lots of things are happening. And however, what we've seen is that this is the third quarter in a row that ClimateTech financing is down. And this is interesting, ClimateTech is not escaping what is happening in the global tech landscape. And I think this is normal, but I just wanted to point this. So lots of things are happening in ClimateTech, but beware, and it needs to be something where you assess truly the resilience of the business model, and you're not doing factor-based investing like what was done in other companies, where you're just saying, oh, this is the climate company, this looks great, let's invest. So you need to do exactly the same work as in other spaces. Now, if we talk about AgTech, I think AgTech is, there are many things happening within this vertical that covers many realities. In fact, I think indoor farming is having bad times right now. Those models are proving to be difficult. So I have some doubts on those models right now. Let's see where this goes. We just did a very important job, as we said, in alternative proteins. So these models are fundamentals. You have Insect, you have Innovation in France, so two leading companies at worldwide level. These companies are fundamentals, and they're producing proteins in a way that is much more sustainable. And that is a way of reaching net zero through this innovation. So these companies are riding on fundamental momentum. Again, as any deep tech company, they have to manage inflation, labor shortages, supply chain issues, which are major and costly. So there's a lot of attention to the cash that is needed on those companies, but if they're able to go through what they're wanting to do, then those will be great companies. And in AgTech, you also have companies that are providing, that are marketplaces for agricultural workers. I have a friend who is a fellow young leader of the French American Foundation with me, Paola, who heads AgEconomy, and they were able to reach to do a major fundraising very recently. So they're providing a platform, a marketplace where agriculturists can buy and sell, buy products in a much more affordable way. So this is bringing huge innovation and allowing e-commerce in that AgTech sector. So I think this is interesting. And HealthTech, well, I think HealthTech is perhaps the sector that is being the most positively impacted by what's happening with Gen AI right now. What was needed in HealthTech was this ability to build on huge data sets in a way that allows to produce medicine in a more accurate way, in more like efficient way. And you're having multiple innovations. I like to talk about one company. I was the founder at the Milken conference I recently attended, and this company is called Proximie. She's revolutionizing the way surgery is done, and she's bringing the power of data to transform the experience in the operation room, where this is much needed, both to allow broader access to good surgery and to actually empower surgeons to do their work in the right way. Again, the sector is facing many labor shortages, and this is an issue. So I think just talking about the three verticals of ClimateTech, AgTech, and HealthTech shows that tech is not one reality, and that you have multiple business models with one key point, which is understanding what is the time to revenue and the time to EBITDA of these models, putting that in front of the capital intensity to get there. That gives you like a framework of companies that are basically getting to revenue quickly, but that are requiring low capex and that have their questions, versus companies like deep tech that are very capital intensive and that have a time to revenue that is much longer. So you need to have the right framework to assess these companies.
And earlier this year, you appeared on my radar when I saw in your newsletter that you'd shared some thoughts on the current tech investing environment. And for anyone that didn't see that newsletter, can you expand on some of the views and the context of the challenges that tech companies are facing in today's economic environment? Because there was quite a few revealing insights in there, wasn't there?
Oh, thanks for reading that first. I tried to share a vision on what's happening in the private markets and across tech environment indeed. So, and what we saw in February, we're seeing different things right now, and the trend is the same, perhaps in a nutshell. So we had a boom in technology investing that followed the pandemic in a way that was almost counterintuitive, because like there was like this burst in financing technology when the markets were not in that great shape. So what we saw was a lot of money coming to tech as AUMs, so assets under management, had raised in a quite significant way across venture capital, across hedge funds, across private equity. And all this money went to fund the economy of today, so tech-based economy, with a lot of factor-based investing. What that means is that investors were making bets on trends. So for example, Peloton in working out from home, Zoom working from home, etc. And so a lot of these companies were financed not because of the quality of their intrinsic unit economics, but because they were responding to almost a macro trend. I think that with the rise in interest rates and with this new 5% point environment that is here to stay, at least for a couple of months, and it's not, for many years, I don't have the answer, no one has the answer, but things have fundamentally changed. So when you have companies whose valuation lies for the most part in the future, because that's how tech companies are built, this has profoundly changed the game. And for the first time, macro matters to tech. So I would like to start with that. So macro as an important way. Now, what is happening? Companies have been overfunded. Companies have a new imperative of switching to profitability and building models that work, again, at unit economic level. So if you're having a contribution margin, for example, in e-commerce that doesn't work, well, getting to growing and saying, well, when I reach this stage, I'm going to have good unit economics doesn't work anymore. You have to show that your contribution margin on product number one is working. So things are much tougher, but I think this is overall very positive as companies are changing their playbook. They've done that, I think, in a more aggressive way in the US, and companies in Europe are still in the process of adjusting the workforce and doing the necessary and difficult cuts to reach profitability at some point. We had good news with Klarna, which announced that they were going to be profitable by the end of the year. So that has to be seen, but I mean, they did that announcement. And so this whole pilot of companies that are reaching resiliency and models that are profitable at some point is a good thing. And again, I think we're in a fabulous period where it's a difficult one. It's a necessary, no one likes doing wet deals, and everyone preferred when funding was available in an easy way and everything was great. However, we're going through a period that is a necessary adjustment. And what's happening for sure is that the highly profitable companies of tomorrow that will be those buyout targets are being built and are today's unprofitable tech companies. So some will not survive, but the ones that will survive and that will have the right playbook will be those companies that you will really want to invest in the next months or years.
We've done a great job today in showcasing some of the challenges that businesses are facing. And I'd love to learn more about your role in how you're helping companies assess risk and promote growth in such a fast-paced, ever-evolving sector like tech. So can I ask you expand on how you're helping companies do all this and more?
Sure. So maybe I can come back on what we call hybrid growth diligence, which is the approach that we have built. So what is hybrid growth diligence? Hybrid growth diligence is the response to saying that to assess a company, you first need to know exactly what you need to look at. That sounds very basic. Things are often basic in this. So you need to understand the strategic framework on which you're going to do due diligence. What this means is, what is the company, what business model is the company in? When you're looking at foundational tech, is this an AI, machine learning infrastructure company? Is this an application? Is this SaaS? Is this e-commerce, etc.? So you start by looking at what is the foundational business model. Then you go to a more precise way, looking at what is the vertical. For example, if the company is in SaaS applications, is it operating in HR tech? Is it operating in AgTech, etc.? This will command different answers to the same questions of the SaaS business model. So you go and understand what is the business model? What is the vertical? What are the unique business model characteristics? How does the company make money? What are the products? Whom does it sell to, etc.? Once you have this understanding in mind, which is again, the strategic foundation, then you do very highly analytical diligence on top of that. And in this highly analytical financial, legal, and also ESG diligence, you're wanting to understand, you're asking the right questions first, and you're having answers that you can benchmark against peers that are at the same development stage and operating in the same business model vertical and with the same business model characteristics. So if you take, for example, a company in restaurant tech, you have a company like Toast, which is a major actor in the US. Well, how is this company different from Toast? How does it recognize ARR in a way that is the same or that is different from Toast? How does it approach gross margin, CAC efficiency, et cetera, et cetera? So it's only by understanding whom is your peer that you're able, in companies in which you cannot look at the past, to assess what is perhaps wrong or what is perhaps the sign that this is a terrific opportunity. And in this hybrid growth diligence, it's not just looking at the risks and what is bad, but it's also being able to tell an investor, wait a minute, this company is fabulous and you should be moving fast, because what I'm seeing here in terms of unit economics, in terms of growth, etc., is amazing. And yes, go through with the investment, and this is how you can underwrite it. So it's an approach that is diligence, but that is diligence in a way that is reconciling your traditional work that used to be done in the big four firms, in which I worked previously, and strategic consulting, but not in the sense that you're doing an understanding of the market trends, but of course you're understanding the market trends, because otherwise you cannot do your job, for sure, but you're having a very bottom-up approach in which you're understanding, okay, here is what I see in the numbers, here is what I understand the market and on the company's value proposition, and how is this company going on that path, and at what pace is it going to go? So that's what we do in a hybrid growth diligence. And our goal is really to partner with our clients, again, to tell them what goes wrong and what is great. I think that's a fundamental difference.
And of course, many technology companies right now are on the frontier of innovation, but with that also comes inherent risks. So I'd love to learn more about how investors can accurately assess the viability of such companies? And are there any specific traits or indicators that they should be looking out for?
I think in our methodology, we assess growth companies according to many pain points. But if I was to make a choice, I think 3 factors are fundamental when looking at the resilience of a high growth and disruptive company. The first one would be quality of revenue. And quality of revenue is you do not value a company in the same way according to if its revenue is basically not recurring at all, or if it's highly recurring. And that defining what is recurring is a skill set in itself. And there's no definition. And we built codification and an index of what is recurring and how to define it. For example, when you're looking at an e-commerce company, well, how do you assess if the company has recurring revenue? Take like Warby Parker, Allbirds, for example, or other companies in the space. Well, a way to approach recurring revenue is to look at the reoccurrence, to do a very granular analysis at forward level, and to identify the patterns to see if the company in e-commerce is building a defensible moat. So that's one example. Of course, in SaaS, it's perhaps easier, but not that much. How do you assess recurring revenue when you have usage-based models? When you're looking at companies in AI and machine learning infrastructure, for example, a lot of these revenues are usage-based. And when you have usage-based, well, we're not having the same definition of recurring revenue as if you were on a subscription basis. Yet, maybe this is even more recurring than if you had like an actual subscription. So first point would be understanding, putting goals behind revenue and to what extent is this revenue recurring and being able to rank that. Second, I would talk about the quality of growth. Now, I coined a theory earlier this year, perhaps you didn't see that in our January newsletter, that I called the theory of the jellyfish. Now, why the jellyfish? The jellyfish is the animal that goes the fastest possible with the less energy use. So it's the most efficient animal in the animal kingdom. And I think companies, when demonstrating growth, have to be like jellyfishes. What I mean by that is that the quality of their growth is to what extent are they able to grow in the most efficient way. And if you take enterprise software, well, being able to grow through expansion on your current logos in a way that Datadog does, for example, where you're able to multiply the revenue by 4 in a couple of months or years because you're building product innovation and you're able to expand on the consumer base, that's very high quality of growth. If you have to put a lot of cash, buy paid marketing and get new customers because you're putting it and money in sales and marketing, that's not a company that is going to be funded in the current environment. So quality of growth, and so by quality of growth, I mean efficiency, is I think the second important point. And of course, you have quality of margins, quality of the gross margin, which ensures scalability of the business model, quality of the operating margin at a EBITDA level, which is how much money that the company have left when it's paid all its costs. And so that's a fundamental measure of value creation. And of course, free cash flow margin, which is how much cash you have in the end. So appreciating the right levels of margins in a very granular way makes sense of where you are on that path to profitability. And if you are already profitable, because a lot of these companies are already profitable, we talk about unprofitable tech. A lot of them are profitable. Well, it's how do you go from 20% of EBITDA to 40% and be like a very valuable company? So I think understanding quality of revenue, quality of growth, quality of margins is the first way to understand resilience.
And just to bring to life some of the things that we're talking about here, do you have any examples that you can share? You don't have to name any names, or just a technology or a tech-enabled company that has maybe particularly impressed you with their ability to adapt and thrive despite the uncertain economic landscape that we're all navigating right now. Is there anything that stands out to you?
Well, sure. So I'm French. So of course, I'm going to talk about companies in my home country because we're doing a fantastic job in France right now. I think one company that we could mention is perhaps HealthTech. So HealthTech, who actually headquartered to Atlanta very recently because they headquartered to Atlanta at the end of last year, they've been recognized as the Gartner as a significant player in robotics and enabling like the whole change of the robotics, like the retail supply chain. So their robots are helping logistic workers to do a better job and to do it in a much faster way. So I'm not going to go more into that company. Of course, it's private matters, but they're doing a great job because they're incorporating technology into a traditional process. And again, retail logistics, and they're using technology to have productivity gains, to go against inflation, to bring technology and everything that is positive technology in these warehouses. And I think they're doing a great job, and they were able to go into their US expansion despite the current landscape, which has, pushed certain plans for some companies. And again, they're following a great playbook that is based on the right level of innovation and on demonstrating on solid customer use cases that they're able to change the way the retail industry is played out. So that's one example. I have many others. I talked about Insect, about the exploration company. I have Datadog as a company that I find very exciting. Snowflake, even though they're consuming a lot of cash. So AgTech is a fabulous sector where many changes are happening. I'm excited about many of these companies, but HealthTech was the one I wanted to talk about.
Fantastic. We started the podcast talking about your origin story. What would put you on this path that you're on right now? And as we come full circle, I'm going to ask you to look back and reflect on your career now, because none of us are able to achieve any degree of success without a little help along the way. So I want to ask, is there a particular person that you're grateful towards? Maybe they saw something in you, invested a little time in you, and ultimately help you get where you are today. But who would that person be? We can give them a little thank you.
So for sure, I would have never started this company if it had not been for my mentor, a partner in Deloitte's audit practice in Paris called Albert Aidan. Albert is a highly entrepreneurial person. He has fabulous mindset, and he believed in me when I was, 22 years old. He took me as an intern, sent me to Los Angeles so that I could learn transaction services and learn all about the US. And now I'm here. And he really put me in charge very quickly on many due diligence assignments. And he believed in me. I don't know how that work was looking back then, but he believed in me, which is, I think, fundamental. Gave me the faith that I needed, and I would never have done that, I think, without his initial support.
Wow, what a great story. So a huge thank you to him. Hope he gets to listen to this podcast and understands the impact he had on your career there, because I think none of us fully appreciate the impact we have when we just spend a little time with people and encourage and mentor others. It's so important. And before I let you go, for anyone listening wanting to find out more information about you, your team, the work that you're doing, sign up to that newsletter. There's so much we talked about. What's the best starting point for everything?
I think going on, we have a new website. So going on the website is great. You can go on the bottom of the page, put in your email, and you'll get that newsletter every month. So it's something that we curate for our readers, which is that no promotion materials whatsoever. It's really what are our thoughts about what we're seeing across the private markets, across the tech landscape, and more precisely, high growth and disruption, because again, high growth and disruption is not limited to tech. And so I think that's a good starting point. And of course, LinkedIn, which is a second way, we put a lot of things on the company's page. So that's how we can get in touch.
Awesome. Well, I'll add links to all those things so people can find you nice and easily and find out more information. Love chatting with you today about how you're spearheading a new form of due diligence, and also the challenges that tech companies are facing right now in the current economic environment, the period of uncertainty that we're seeing, and also the importance of assessing risk in order to promote growth, all washed down with your inspiring backstory and your mentor there. But thank you so much for sitting down and sharing that with me today.
Thank you for your time. It was a great conversation.
I cannot thank today's guest enough for coming on and sharing your insights on the challenges tech companies face in the current economic climate. Not to mention the significance of properly assessing risk and its importance on fueling growth. And I, for one, have learned a great deal today, from understanding the transformative nature of technology in various sectors to the need for a more revamped approach to due diligence. And it's clear that the tech investment environment is complex and rapidly evolving, and I think today gave us a glimpse into some invaluable perspective on navigating this landscape. But as always, if there's anything you'd like to add to the conversation, email me now, techblogwriter@outlook.com, Twitter, LinkedIn, Instagram @NeilC.Hughes. We'll keep this conversation going. But that's it for today, so thank you for listening as always, and until next time, don't be a stranger.